Over the past 3 years, something almost unthinkable happened to Florida's housing market. It didn't just slow down, it turned into a financial minefield faster than buyers expected. From canal-lined Cape Coral to glittering Miami Beach, sellers felt unstoppable. Prices jumped by hundreds of thousands in months, and buyers were pressured to do anything just to get in. But 2026 flipped the entire script. That seller advantage is fading fast. Markets that were packed with bidding wars and sight-unseen purchases are now seeing rising foreclosures, distressed listings, and price cuts stacking week after week. And it's not just a gentle cool-down. Some areas are sliding into double-digit drops while inventory builds like a dam about to break. Insurance pulled back. Condo owners got hit with special assessments, and buyers have reached their breaking point. Incentives are back, listings are sitting longer, and the power dynamic is shifting again. Away from sellers toward buyers who finally have leverage. You're watching Across.us for, and today we're breaking down the top 10 Florida cities where buying a home in 2026 could be the biggest financial mistake of your life. Stick around for number 1, because what's happening there could reshape the state's housing future for years. If you want cinematic deep dives into real estate trends, hit subscribe, and let's get into it. Before we count down, here's how we're judging worst. It's not one statistic. It's 4 risks stacking at once. Price risk, how fast values are falling. Inventory risk, how many homes are sitting unsold. Carrying cost risk, insurance, HOA fees, taxes, assessments. Exit risk, how hard it is to sell later without taking a loss. When those collide, you're not buying a home. You're buying a problem. All right. Number 10. Number 10, Orlando. Orlando surged from 2020 to 2023 as remote workers poured in and new developments exploded across the metro. Prices soared, sellers got bold, entire neighborhoods transformed almost overnight. For a while, it really looked like Orlando was becoming Florida's next unstoppable economic engine. But by 2026, the momentum cracked. Prices are down around 8% year over year in many areas, inventory is up sharply, and new builds that once looked like the future now feel like oversupply. Return-to-office policies weaken the demand wave, and the market is paying for it. The trap is that Orlando looks discounted, but many listings come with hidden landmines. HOAs, insurance shocks, repairs, and builders still competing with incentives you can't match later. If you buy at the wrong time, you're not catching a deal. You're catching a falling knife. Number 9, Lakeland. Lakeland sold itself as the affordable sweet spot between Tampa and Orlando. Developers flooded the area with subdivisions, betting demand would never stop. Thousands of homes came online fast, faster than local fundamentals could support. Now the city is dealing with real distress. Foreclosures have surged, prices are slipping about 9% in many segments, and homes are sitting longer as sellers panic cut. The biggest pressure point is affordability collapsing under carrying costs, especially insurance. Lakeland is what happens when costs rise like a major metro, but incomes don't. Number 8, Palm Bay. Palm Bay looked like the next breakout. Space Coast energy, coastal lifestyle, and prices that felt reasonable compared to South Florida. Investors piled in, and builders expanded aggressively. Then the insurance reality hit. Premiums surged, buyers backed away, and prices fell hard from peak levels. Foreclosures climbed, listings piled up, and sellers now throw incentives at buyers just to get attention. Palm Bay's warning is simple. If your affordability depends on ignoring coastal insurance risk, you're not buying a bargain. You're buying exposure. Number 7, Fort Lauderdale. Fort Lauderdale rode the luxury wave, especially condos. But by 2026, the condo market is getting crushed by inspections, reserve requirements, rising HOA fees, and brutal special assessments. Many owners can't afford the new costs. Many buyers won't touch the liability. That's how luxury turns into a financial cage. You're stuck paying more every month while resale demand dries up. The risk isn't just what you paid in a day. It's what the building forces you to pay after closing. Number 6, West Palm Beach. West Palm looked untouchable with corporate relocations and high-income demand, but now prices are sliding, foreclosures are rising, and carrying costs are eating the market from the inside. Insurance increases plus condo assessments are turning ownership into a monthly stress test. Even strong buyers hesitate when the long-term costs feel unpredictable, and when buyers hesitate, the market doesn't stabilize. It weakens. Number 5. Northport. Northport became the escape city when Sarasota got too expensive. Prices surged anyway, far beyond what the city's fundamentals justify. In 2026, that mismatch is correcting hard. Inventory is heavy, listings sit for months, and buyers expect deeper cuts. Add insurance pricing that can still reflect county-level risk, and the all-in cost feels too high for what you're getting. Northport's core problem is exit risk. You can buy today and still struggle to sell later without a painful loss. Number 4. Deltona. Deltona's identity was affordability, but in 2026, it's turning into a cautionary tale. Foreclosure pressure is rising, values are sliding, and families who bought near the peak are losing equity fast. Carrying costs rose faster than wages. Insurance and taxes turned cheap into impossible. And when households run out of room, the exits get ugly. Deltona proves the sticker price isn't the real price. Number 3. Ocala. Ocala grew fast on retirees, snowbirds, and families priced out bigger metros. Builders expanded aggressively, and entire new communities popped up in a rush. Now the market is softening, foreclosures are rising, and builders are offering heavy incentives to clear inventory. Upgrades, closing credits, rate buy-downs. Retirees on fixed incomes are getting squeezed the hardest as insurance and taxes rise. So Ocala's question in 2026, can the lifestyle survive the economics? Number 2, Miami is still Miami, but the housing math is getting uglier. Condo values in certain pockets have been hit hard. Vacancies rose in high-end segments, and incentives are back. Special assessments, insurance pressure, and long-term climate risk perceptions are changing buyer behavior. Miami depends on constant inflows of capital, so when demand cools, the shift can happen fast, and it can spread. Miami's rule: never buy a condo without understanding reserves, assessment history, and insurability. Number 1. Cape Coral. Cape Coral is the collapse nobody expected. It was one of Florida's hottest boom markets. Waterfront lifestyle, fast appreciation, non-stop demand. By 2026, it's become one of the most distressed markets in the country. Prices dropped hard from peak levels, more owners are underwater, and inventory surged. But the biggest issue is insurance. Hurricane exposure and flood risk turned ownership into a recurring bill that keeps rising while values fall. Add seawalls, corrosion, and constant maintenance, and the waterfront dream turns into financial quicksand. Sellers cut prices, buyers wait, and the market gets stuck in a brutal cycle. Cape Coral is the clearest warning in Florida. The purchase price isn't the danger. The long-term cost is. And across Florida, a bigger reckoning is unfolding. The era of chaotic bidding wars and effortless appreciation is being replaced by foreclosures, falling values, and buyers who finally have leverage again. Some cities will stabilize. Others may take years. But the lesson is universal. No housing market can outrun reality forever. You've been watching Across.us for. If this breakdown helped, hit subscribe, turn on notifications, and share it, because what's happening in Florida may be just the beginning. And as always, the numbers